This video we are going to talk about deriving and applying capital asset pricing model, and we will discuss how the relationship between them. Let's begin. Uh, Capital asset pricing model. Let's describe assumption and underlining capital asset pricing model, and I would like to mention about again William Sharp and John Linter. Capital asset pricing model was developed by William Sharp and John Linter in the 1916s. It builds on the ideas modern portfolio theory at the capital market line that investors are assuming of the sum combination of the risk-free asset market portfolio, and we have some assumption here. First of all, the vast assumption here market is freely available for information, guys. Right? Information freely. Fractionless markets, the mean is fractionless, sorry. Fractionless, fractionless markets, there are no taxes on commission on transaction cost. Another one is fractional investment are possible. That is, assets are infinitely divisible, meaning that investor can take a large position as well as very small position. Another investor, another assumption is perfect competition. Perfect competition. Individual investor cannot affect market prices through their buying and selling activity and are therefore viewed as a price takers. Uh, uh, Another one is investor make their decisions solely based on expected return and variance. This implies that deviation from normality such as scams and curtailments are ignored from decision-making process. If you are holding cap process, ignore please. Sorry, ignore scamness and kurtosis. What is ignoring kurtosis and scamness? This is a you should have normally distributed market data. Market participants can borrow and lend unlimited amount of their risk-free rate. Last one is homogeneous expectations. Investors have the same forecast and expected return variance and covariance over single period. Clearly, CAPM make number of unrealistic assumptions here. As with other model, care must be taken very when relying solely on the result from the CAPM. Um, we need to estimating and interpreting systematic risk here because CAPM is really good relationships with systematic risk. We need to calculate our beta. The expected return of risky asset in the market portfolio are assumed only depend on their relative contribution for the market risk of the portfolio. The risk-free asset with which each asset represents the sensitivity of risk returns on the market return, as referred as the asset beta. Beta is computed this. This is beta. Covariance covariance of sorry uh, covariance of asset return with the market return and variance of the variance of the market return. What does that mean? You need to have covariance return, covariance asset return with market return. Then you should divide it by variance return of the market return. You'll get beta here. And this is covariance asset market divided by variance market. Another formula is one more formula here to calculating our beta. This is our correlation market and asset times sigma asset divided by sigma market. I mean standard deviation. Correlation and standard deviation. You'll get covariance here and divide by again the market. Another formula, this correlation market and sigma asset divided by sigma market. We will demonstrate that market beta by definition equal to 1 and any security of the beta of 1 moves in the 1-to-1 relationship with market. Consequently, an insecurity beta greater than 1 moves by greater amount of and is referred as cyclical, like a luxury goods. Insecurity with beta below 1 is referred as defensive, like a utility stock. A cyclical stock from better during expansion, whereas defensive stock for better in regestion. Let's calculate our asset beta with an example. We are assuming that we have asset A standard deviation, asset A standard deviation 30% and correlation return market is 0.8. What is the our a beta, asset A beta, and market return is estimated, market return estimated 20%. So let's have our formula here, times sigma E sigma m. So 1.18, 0.30, and 20%. This is our beta and relationship about our market data and asset data slope. Actually, we are finding here our slope, and if the covariance, let's have a covariance example here, and if the covariance asset return on uh, market index is covariance EIM 0.0848. No need this one. No need this one. What is the market asset beta here? Again, same question. Covariance and sigma square, and we have covariance over market return square, right? This is covariance finding beta. These are really same, but you should define which one is better to you. In practice, we estimate beta by regression assets returns against the market return. While a regression is a concept, this can discuss it. The purpose of our reading, our video, you can think of our mathematical estimation produce fits line of the data plot. Let's have a data plotting here. I mean, I need to draw it. asset, excess, return, and market, excess, return. Oh, yeah. This is our regression result, right? Uh, and these are error term or residual anyway, I would like to say. And we have a slope here, right? Like a derivative. Anyway, beta E equal slope covariance market and asset and divided by variance market. This is our regression analysis and least secured regression line, however you want to say. If you have regression result, you'll see beta captioned on your result, captioned like a this result. This is your beta, okay, in regression result. Estimating beta with regression will represent the excess return asset I as a dependent variable and the excess return on the market index independent variable. The least secured regression line that minimizes sum of secured difference between differences of the points from the line. This mean what is meant by the line of best fit. The slope of slope of this line, our estimate of our beta, and we driving driving capital market, capital asset pricing model. Let's driving in uh, driving capital asset pricing model. Let's interpret the derivation and components of the CAPM. A straightforward CAPM derivation recognized as expected return only depends on beta, only depends on data. But remember that company specific risk can be diversified away. Uh, only depends on beta and linear function of beta is linear function of beta. We therefore obtain the following equation. Here I will give you an equation where expected return is explained as a linear function of beta and with intercept equal to a and slope equal to mu. We have an equation here ERP equal A plus M times beta P. This is a regression equation. And we have a graphic here. Uh, beta and expected return, risk-free rate, and security market line about CAPM calculation. And we are looking our beta and return. So this is about non-symmetric, non-systematic risk. Okay, non-systematic risk. So this looks like about Sortino, right? We are looking beta. If we are looking beta, this is about Sortino, and if we are looking sigma, I mean standard deviation or variance, about numerator and denominator. This is about Sharp ratio, right? Last video we did look the Sharp ratio and capital market line. Now we are looking security market line, and this is about Sortino. The graphical depiction about the equation is the null security market line. The security market line, the intercept occurs equal to 0 uh, when there is no systematic risk. The only asset with zero market risk-free asset which is complete and correlated with market movements and offers guaranteed return, and therefore the intercept of the security market line is equal risk-free asset rate of the risk-free rate of the risk-free rate of return and risk-free. I mean, I would like to say that the intercept of the capital market line is equal risk-free rate of return. To calculate value of the slope, we will need to know 2 points among the line. We already know coordinates for the risk-free asset, which are 0 and RF, 0 and RF. We also know coordinate market portfolio, which must be 1 RF. The market portfolio has equal to market return. By definition, it's systematic. I mean, beta risk is equal to 1. The later point can be easily demonstrated, remembering that covariance of the return asset with itself equal variance. Uh, for instance, beta covariance market to market and sigma m is equal sigma m square. What should be equal here? What should be equal? Of course, this is equal 1. We now read the calculus slope of the security market line as the rise of the run of the line. Uh, the slope is no market risk premium. I mean the slope market rem minus RF over 1 over 1 minus 0. So FA is equal market risk premium. Okay, market risk premium. We are looking market return and risk-free difference, and we will get market risk premium, like a risk premium. The recall expected return in our function of beta, um, linear function of beta. We have this formula here, RAP A plus M plus beta P. This is a recall expected return is a linear function of beta, and we have using substitution um, CAPM formula, expected return asset equal risk-free rate plus uh, expected return market minus risk-free and times beta E. This is a market risk premium. Market risk premium. We are looking our market risk premium and plus risk-free asset and times beta, right? This implies that expected return of investment depend on the risk-free asset. The market risk premium here and systematic risk of the investment B. The expected return can be viewed as the minimum required return. Maybe this is looking like a minimum market return. I mean required return and or the hurdle rate. Hurdle rate is a minimum required return, and that investor demand from investment given is the level of systematic risk. Estimating hurdle rate accurately is very important. If investors use inflated hurdle rate, they may incorrectly forego valuable investment opportunity. If, on the other hand, the rate used too low, investor may have purchased overvalued asset here. So we are looking asset return via CAPM, and we are determining overvalued or undervalued CAPM result. I mean return result. Let's 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 applying CAPM calculates expected return on asset here. For instance, assume you are assigned a task of evaluating an gökkaya air gökkaya air. To evaluate stock, you need to calculate required rate of return using CAPM. The following available, I mean expected return is 5%, and RF is 4%, and Gokkaya beta is 1.5. So let's calculate, and maybe I can draw uh, their number. uh, RF, sorry, RF is point, and all right, all right. This is market return. This is Gokkaya, and this is our security market line, and this is beta, and this is our expected return. Our Gokkaya beta is 1.5, and beta market is of course 1, and 0.09 and 0.115. This is expected return Gokkaya, and this is expected return market. Okay. So in this case, hurdle rate is 11.5% here. 11.5%. If investor predict that return will exist, 11.5%, they should be buy Gokkaya Air stock. However, if investor predict expected return will be less than 11.5%, then they should either shy away from Gokkaya Air stock or short the stock if allowed. This so because stock is overvalued, guys. Okay, look this. If CAPM result have 10% return and Gokkaya stock have 9% stock hits. This is mean that CAPM have 10 value here. This mean that our valued and reverse and CAPM pricing. This is undervalued. So buy and sell position here. In previous example, we calculate rate of return here. Uh, by the way, the 11 this 11 is our CAPM result. Okay, 11.5 percentage is CAPM result. I didn't calculate it, that I just assume it random valuable number. Sorry, I just assume it with random numbers. And previous example, we calculate rate of return, which always is lies on the security market line. If analyst that determines that expected return indifferent from recurrent rate of return implied by CAPM, then security may be mispriced according to rational expectations. Mispriced security would not lie the security market line in general. In general, we can say that an overvalued security would have required rate of return computed with CAPM that is higher than unexpected return computed by analyst evaluation. An overvalued security would plot below the security market line. I mean here would need to plot security market line. And undervalued security would have required rate of return computed by CAPM that is lower than expected return computed by analyst valuation, and uh, that, sorry, if undervalued security will have required rate of return that is lower than its expected return, and undervalued security would plot the security market line. Actually, that's all what I want to say about capital asset pricing model. Actually, I think I did explain it everything about capital asset pricing model. Before finish my video, I would like to say about Epps assumption. Uh, Capital asset pricing model. Always remember information freely available and perfect computation. Investor make their decision and homogeneous expectation, market participant, and always remember if you are looking for cap and pricing model and uh, interpretation or your asset return, always remember ignore skewness and kurtosis. For instance, arbitrage pricing model theory never ignore scams and kurtosis because they have unique estimating equations. And always remember again normality. Okay, normality, normal distributed, normal distributed. Remember always this. Thank you for watching me. Thanks for your attention. Next video we will discuss again about same topics. Here I will be again here, and this chapter looks like a really funny. And next video we need to look performance evaluation measure and sharp performance index trainer Jensen alpha and tracking error. These are a performance evaluation process. We need to discuss them, how they have relationship between CAPM and other pricing methodologies. See you guys. Thank you.